Hello, and welcome to the Edison Business Advisors webinar. This is a rebroadcast of a webinar we did earlier. We did have some questions from folks, so what we did is we updated some of our material, and we are updating this this broadcast. So thank you for joining virtually as you watch this. So myself, Steve Niehaus, Michael Pfeffer, and Eric Gall will be discussing business valuation and kind of demystifying some of the things you hear about as far as understanding how to value a business. We are going to have our information available. You see it right here, but also at the end of the presentation. And you can always go to edisonba.com to learn more about each of us, as well as contact us and look and see what our business offerings are. So as far as jumping right in, invariably, whenever the three of us meet someone, a business owner, they're like, what do you think my business is worth? Well, it's a very difficult question. Well, it's an easy question, but the answer may not be as easy. First of all, and this is sometimes a challenging one, is we actually have to know if you really do truly have a business. And what I mean by that is there are a lot of folks who have successful businesses that they manage themselves, but quite frankly, they are the business. So what we look at is to understand if the business continues to operate and continues to ring the cash register. If the business owner goes on vacation, then that's a business. However, if you are Joe's Plumbing and you're the name of the business and you are the revenue producer, that one's a little more difficult to say you have a true business that's able to be sold. So the simple question as far as what's my business worth? Well, it's going to be whatever someone's willing to pay for that. And quite honestly, we're going to sound like a lawyers a little bit, but it really depends, and there's quite a number of factors. And when we get into business valuation and appraisals, that's where we'll try to sort through this and help you have a better understanding. So what I'd like to do is introduce Michael Pfeffer to talk about the business valuation process.
Great. Thank you, Steve. Why in the world would I want to have a valuation of my business anyway? It's a pretty good question, but there's actually many reasons why you might want to have a valuation. First of all, if I'm in business and I've been working for a year, I'd kind of like to know if I've created any value. There's also a number of other reasons that can be legal or technical. But if you want to sell the business, you have to figure out what it's worth. So if somebody gives you an offer, you know whether it's a good offer or not. And that's whether you sell it to a third party outside or if you sell it to somebody in-house, and you may want a different valuation based on those parameters. So when I mean in-house, you might sell it to a management team or an employee or a partner, or you could even sell it to all of the employees with something like an ESOP, an employee stock option program. Or you may want to gift the business. So if I'm selling the business, I'm probably going to want a high value. If I'm going to gift the business to my kid, I'm probably going to want a low valuation because I'm going to have to pay taxes on that value. We also have situations where there would be a forced sale or maybe a less than open market sale. And it may be unplanned and unfortunate, and we refer to them as the deadly Ds, and it could be anything like death or a dissenting shareholder action, disability, which is probably the worst. It could be damages or anything like that would force you to have a valuation and convert the business into something else. You can also just have a valuation for strategic planning. If you have a certain dollar amount in mind that you need to walk away from the business with, you need to know if you're there today, and if not, how long is it going to take you to get there? There's also tax reasons. I get called in to do appraisals for estate and gift taxes. If somebody owns a business and they pass away, they have to file either a 706 or 709 tax return to either gift the business or for estate planning purpose or for the estate and file taxes on that as well. So there's different types of value. So when we sell a business, typically we're looking at fair market value, the value to the marketplace, but there's also something called fair value, which is a statutory value. And that tends to be established by the states and is often used in situations like divorce or dissenting shareholder actions. We have book value, which you can find on your tax returns or on your financial statements, which is really no value at all, except it's a tax value, has no relevance to the real world. Asset value, if the business is non-operating, which it may be right now in the COVID environment, if it's not operating, then the business is really worth the collection of assets that comprise the business. There's also investment value, and this is typically the highest value. It is usually by a competitor or somebody that's looking to roll up the businesses in the market. They're willing to pay a premium over fair market value because they may be capturing market share, or they may be stealing technology. I shouldn't say be stealing, I mean buying technology, and the employees as well. So, and then there's something called intrinsic value, which is really the value that's in the eye of the beholder. I know I've looked at some pieces of art that I wouldn't give you 2 cents for that are worth millions of dollars. The fair market value is what's most commonly used both for tax purposes and really when we're looking at selling a business on the market, because it refers to a willing buyer and seller, neither being under compulsion to buy or sell, and both having reasonable knowledge of the relevant facts. A reasonable is kind of a variable there. This is actually codified in Revenue Ruling 5960, and we're required to abide by this when we're doing estate and gift tax valuations, and not so much when we're doing other valuations. But fair market value is what we usually use when we're selling a business. Now we have to ask value to whom, because different users of the value may have a different idea of what that value is. A buyer typically looks at past performance because that's what they're going to expect to happen in the future. A seller wants to look at the most positive and highest value, which is usually includes growth for the future, so they tend to look forward. Bankers actually look both directions. They want to know what's happened in the past, but only as much as it's going to give us an indication of what's going to happen in the future, because they want to make sure that they're paid back, and the buyers are also going to want to make sure they get a return on their investment as well. So the banker strongly weighs the historical and looks forward as well. Now, there are different kinds or levels of appraisal that we work with. A full appraisal tends to be very comprehensive, and it can take some time to get done. Usually they're used for litigation matters, or in some cases in divorce, but usually for dissenting shareholder actions and things like that. They can be 100 pages long. Nobody wants to read them, and we don't have that much fun writing them. A limited use appraisal, we're now allowed to use a limited use appraisal for tax purposes, where we weren't about 5 years ago, we were not able to do that. It's a shortened version. It still tells everybody what was done, why it was done, how it was done, but it doesn't have to go in and tell you what was not done. Usually about 30 to 50 pages long, pretty thorough and pretty reasonable. We also have what's called a calculation of value, which is based upon agreed upon terms between the appraiser and the user. They can be very complicated as well, or they can be very simplified, and it just depends on the purpose and the use of the valuation as to how far you want to go. As a business broker, we use what's called a broker's opinion of value. It's not a certified appraisal, but it employs many of the same techniques that an appraiser uses, and they typically are surprisingly close to what the appraiser would come up with as well. These are used typically by intermediaries and to establish a value to take to market. There are 3 general approaches to business brokerage. One, we assume the fair market value. We have a willing buyer and a willing seller. We employ the broker's opinion of value, so we can set a reasonable price, and price is always a range because it depends on who the buyer is. So different buyers will put a different price or a different value on that business. We tend to look at all the valuation methods and decide which one makes the most sense or which ones make the most sense and weight them accordingly. It really comes down to what does the buyer think the business is worth, and again, it depends on what type of buyer that is. So what does a buyer really want to pay for? Well, first of all, they want to get positive cash flow. If there's negative cash flow, it doesn't make any sense to buy the business. They're looking to make an investment that will return an investment on a reasonable return on their investment, and also provide them with income. So if they go to the bank and borrow money, they need to make sure that they cover the debt and provide that return on their investment and their income. Typically, they will look for growth. They want to be in an industry that's growing. If they're in an industry that's kind of going down at their end of their business cycle, probably not a great investment. In order to do a deal and to do the valuations, you really need to have excellent financial records. It's the #1 reason that businesses do not sell is because they don't have good books. Any cash needs to be documented. We have to have the business owner understand that for every dollar that they don't tell Uncle Sam about and they put it in their pocket, it costs them $3 in value, where they would have only paid 20 to 30 cents in taxes on that dollar. So for the last 2 or 3 years before a business owner wants to sell, they really need to account for all of the cash, particularly in hospitality businesses where it's really easy to not count the cash and just put it in your pocket. Also, we need to account for personal expenses. That could be the kids' tuition or the cars or the phones or the condo in Vail or the 46-foot Hatteras or the airplane. So all of those things, if they're not related to the business, we need to get them off the books and account for the cash. What's very important to many buyers is the repeat business. So if you have contracts in place that generate recurring revenue, that tends to be much more valuable than just one-off sales. And they also look at diversity in the client base. So we don't have all of our business coming from one customer. That's very risky. And we look at diversity in geography. If we happen to be operating only in Southwest Florida and a hurricane comes through, then you're shut down. And we also look at diversity in products. So if there's for instance, a law that's passed that makes it so you can't sell one of your products, you want to be able to go to selling another product and maybe going to other vendors as well. Other key attributes, employees. Do you have, if you have employees, are they kind of tied to the business with golden handcuffs, or are they easily replaced, or do they get up and go? What kind of skill levels do they have and certifications? Do you have your operations documented? If I want to buy your business and I don't know anything about it, I need to have a manual in place that'll help me get through all of the technical issues. The market presence, what do you invest in marketing so that you can grow your business and sustain your business? And it has to be trackable. If it's not measured, we can't help it or we can't fix it. And what's the owner's impact on the business? It's not a business till it runs without you, until it's a job, or until then it's a job or a profession, or call it whatever you like, a career. But if it runs without you, now it's much more valuable, because maybe I don't want to work 80 hours a week. I just want to work 40 or maybe less. So, okay. A few additional attributes that buyers look at. How long have you been in business? If you're brand new, you may not have much of a track record. And if you're only been open for a year or two, you may have incredible growth, but it may not be sustainable. What's it take to get into your business? Is it very, very expensive? If so, then it might be tough for other people to get in. And if I'm buying your business, I think I'm going to like that. Stability of the industry. Are you in a growing industry or a dying industry or a stable industry? And you can also look at that market as well. Is your market growing? Here in Southwest Florida, we have a lot of people from Ohio that are moving here to get out of the cold weather, and the Midwest and other states as well. Do you have proprietary technology? If so, is it protected? Do you have patents? Do you have trademarks or service marks? And again, your geographic locations we talked about. Are you in one location or many? What's your degree of competition? Are you competing on price, or are you competing on service? And then what's the age of your capital asset base, your equipment? If I buy your business and it has a lot of old things, am I going to have to come in and replace those? Or have you been replacing things all along? So these are just a few of the attributes that a buyer will look at. And all of these will have an impact on the value depending upon how much weight the buyer puts on them. Steve?
So thank you, Michael. Michael teed up the valuation, the different types of valuations and the broker opinion of value. So how do you get started on this process? Well, we work through what we call as a checklist, a valuation checklist. It could look like a wish list because there's quite a number of items on there. But our goal with this checklist is to accumulate all of the available information about your business to help us give a realistic and true value. And so primarily we start with the tax returns, last 3. If you have 5, that'd be great. But last 3 years of tax returns, the P&L statements, bank or balance sheets. And then we go through and look at all of the individual items that Michael talked about as far as adjustments, the owner's compensation, some of the non-required expenses, the discretionary expenses, and any lease agreements, anything that has to do with better understanding your business. Obviously, the assets that are part of the business, And then getting prepared for a buyer is, as we start accumulating the data, is having bank statements will help reconcile the financial statements, et cetera. The last 3 years of sales, understanding your customer base, looking at your inventory, the inventory turnover, et cetera. You can look at the list of items. And again, we'll have this available for you if you simply send us an email or contact us through our website. So the goal here, again, is to maximize the value and have us present a full picture of your business value. So what we look at is what we call owner benefit. There's a bunch of terms that are used interchangeably: owner's benefit, seller's discretionary earnings, adjusted net income, etc. What it's not net income. So if somebody says, "Oh, my net income is X," that's nice to know. But what we're really trying to get is, if I bought this business, what would I expect to derive as far as financial benefit to me as the new owner? And what we do is we look at what the tax preparers have done, which is they prepare your taxes and minimize your liabilities to Uncle Sam. So if you look here, these three columns, the financial data. The first column is the tax return. So if you look through, you can see the different expenses. And if you drop down and see the net income is $27,000, that's our starting point. And then we sit with the owner or the seller of the business and truly understand what goes into those numbers. And we make our adjustments, as you see from the middle column there. So we adjust for the owner's salary. He happens to have a non-working spouse who's being on the payroll, so we would adjust for that. The non-cash items, depreciation, amortization, things like that get adjusted out of there. You'll see one item going the other way, which is rent, because in this situation, the owner owned the property. So a new owner would need to accumulate or account for the rent or a lease of a facility if he or she needed to lease a facility. So we go through and look at the discretionary items, adjust those. And as you see, all of a sudden that $27,000 becomes $200,000. So what this is saying is that the owner benefit or seller discretionary earnings is now $200,000 that a person would expect to get from acquiring this business. And as we look at the approaches on getting to the valuation, there's three primary approaches: asset approach, income approach, and market approach. And each of those have different methods under them. And Eric Gall will now drill a little deeper into the different valuation methods.
All right, thank you, Steve. As mentioned, there's three valid approaches to valuation that we use, but there's 8 methods below each of those 3 approaches. With the asset approach, there's 2 methods, and with the income and market approaches, there's 3 methods each. So let's dive into each of those methods, starting with the methods under the asset approach. The underlying principle for the asset approach to value is based on the principle of substitution. In other words, what would a buyer be willing to pay for an equally desirable substitute for your business? So we look to determine the sum of the parts of the business. For example, there are tangible assets, such as trucks and tools if you're a contractor. There are intangible assets, such as a customer list and your reputation, and any additional value that is generated by the business we would call goodwill. So the first of the 2 methods under the asset approach is the excess earnings method. And what this does is it adds the market value of those tangible assets to a multiple of the excess earnings generated by those assets. The excess earnings are calculated by subtracting the carrying costs of those specific assets from the cash flow that's generated by the business. And I'll show you an example of this on the next slide. But before we jump to that, let's talk about the other method, and that's the net asset accumulation method. This one's used when the fair market replacement value of the assets represents most, if not all, the value of the business. This method is used only when businesses are failing to generate more than a fair compensation for the owner's time and effort that they spend putting into the business. We'll see a little bit more of this with COVID-19 now, where businesses have been shut down or have failed. And we'll use this, the net asset accumulation method, to value, businesses that are not operating, as Mike mentioned earlier. Okay, here's the example of the excess earnings method calculation that we did for a manufacturing company. I'm not going to go through the mechanics of that, but you'll notice here at the bottom that this method, produced a valuation of roughly around $11 million for this particular business. Now let's look at the income approach. The underlying principle of the income approach is that value is determined by the present value of future cash flows, discounted for the appropriate risks and rewards of that business or industry. The first method is the discounted future benefits method. This requires a business plan with defendable trends and actions so we can estimate future income. The future income is discounted to its present value. The discount rates, we typically find those in either publicly traded stocks or small business sales data. And I'll show you an example of discounted future benefits method on the next slide after I talk about the next two approaches. The second method is the multiple of discretionary earnings method. This method was developed by business brokers from Texas back in the 1980s, and it's dependent upon a multiple or a cap rate based on a buildup of subjective information and risk factors that are associated with the given business. This multiple is then multiplied by the discretionary earnings of the business to determine value. I'll show you an example of this in 2 slides. The third method is the capitalization of benefits method. This method takes some simplifying assumptions such as the adjusted incomes of the previous year being the best representation of future years, and income will grow at a uniform rate in the future based on past growth history. We all know the past doesn't necessarily predict the future, especially right now when you're looking at our present state with the coronavirus and how that's impacted, 2020 earnings. What, would we use that as a year to build off of in the future? Or would we take some, average years? But the problem with this method is it's really easy to abuse, just due to over optimism, on the evaluator's part, which would skew the assumptions to the benefit of the seller. Or, if your last year, was very poor, say due to like COVID-19, it may underrepresent your future earnings. So let's take a look at discounted future benefits method. This is one we did for a chain of fast food restaurants. They had a business plan in place. It talked about the addition of 2 new locations in the following year. So we could take the growth curves of past locations in order to predict future cash flows, from the growing business. And then we applied a discount rate. In this case, you'll see down in the bottom middle, it was a 25% discount rate that we used. That's because there's a high risk to operating restaurants. So when you take the net present value of those future cash flows, in this instance, we created a valuation here highlighted in yellow at the bottom left of nearly $3 million for the chain of restaurants. This is an example of the discretionary earnings methods that we did for an engineering services company. In the left-hand column, are a list of attributes of the company. The second column, the inputs, are scores for each attribute, and then we calculate a cap rate, based on each one of those scores, and then sum that to create an overall cap rate at the bottom, and then again apply that to the discretionary earnings as a multiple to create, a valuation here, which is just shy of $2 million, again in the bright yellow box. Now let's talk about the market approach to valuation, and it's based on the premise that similar businesses will sell for a similar price. So I'm going to assume all of you own small privately held businesses, so I'm only going to focus on the direct market data method, the first one here. There's 2 other methods, the public company and the M&A methods. They're reserved for much larger businesses. But for the most of us here, I think we're talking about small businesses, so we'll talk specifically to the direct market data method. So we'll take your business and we'll compare it against sold business data to calculate 2 to 3 multiples. Those multiples would be revenue and seller's discretionary earnings. And if the business is large enough, say generating over $500,000 in seller discretionary earnings, we may use what's called an EBITDA multiple, EBITDA being earnings before interest, depreciation, taxes, and amortization. And this data can come from a number of subscription services. They're listed here over on the left. We subscribe to 4 of the more popular data services. Many brokers may subscribe to only 1 or 2. Oftentimes it takes actually 3 or 4 of these services to find enough comps to value your business, appropriately. So it's a good question to ask your broker, just find out where they're sourcing their data for comps. And if they're only using 1 or 2 services, you may not get the best valuation or an accurate valuation from your broker. And here's an example of the direct market data method. If you look at column A, we've got 20 businesses here that were comparable. And columns in E and G, you'll see the multiples that we're looking for. E is the what we'll call the revenue multiple, and G is what we call the seller discretionary earnings or earnings multiple. And we'll take those multiples, we'll apply them to your revenues and your discretionary earnings to come up with a valuation. And if you go to the very bottom where the green circle is, you'll see that the revenue multiple was about $480,000, and the earnings multiple created a valuation of about $400,000. So after we execute all these different methods of valuation and come up with, several different numbers, what does it mean? Well, the next step is really to weight each method, as Mike alluded to earlier. We do it based on its relative merits. And then usually we find that the direct market data method is our highest weighted, followed by income approaches. And then finally, some of the asset approaches would be the lowest weighted items, but it all depends on the circumstances surrounding the business. So once we weight these, we're going to come up with what we call our most probable selling price. And then going to market, we generally add a small padding to that most probable selling price to give a little bit of negotiating room. And then finally, what we do is we test that price against multiple things. We do an SBA lender test to make sure that the business at that price is bankable and a lender will land on it. We'll do what's called an acid test, which I'll show you an example of, after this slide. And of course, the most important test is the market. How much will someone pay for your business? And once they let you know, we learn quite a bit about, whether that valuation and pricing is accurate. So here's an example of an acid test. There's 2 columns here. The first column is the cash sale scenario, and the second column is the finance purchase sale scenario. And what we want to do is make sure here in either scenario that the business, yields enough cash flow to pay the owner or new owner enough salary to make it worth their while to run the business. Their time and effort, associated with running the business, it pays off. And it also needs to cover the debt service. And then what's left, we usually take that and we divide by that initial investment to come up with what we call a return on investment. In the first column, you'll see circled in red, in the cash scenario, the business yielded a 34% return on investment. We like to see this number right around 33%. I've never sold a business where this number's been under 25. So it's, a critical number, and the acid test really yields, a lot of information to us, the broker, whether or not the business is sellable at a given price. And you'll see here in the other column, it yielded a 71% return on investment, after the debt service. And in this case, I always look for a number that's right around 60%. And I've never sold a business where this return on investment is less than 50%. And it's much higher in the finance purchase scenario, only because when you go to a bank and the bank lends you money, you're going to have to they're going to lien your assets, your house, your cars, whatever you have to make sure they get paid. So it's a much higher risk for a buyer. Therefore, it requires, a greater return. You'll also have a much lower down payment because you're only paying 20% down versus in a cash sale, buying the seller out at 100%. So here's the, the next slide. This is some fun facts about business sales. You can read through them here as we kind of conclude, but.
Say, Eric, it looks like we have a question here.
Okay.
On the market direct data approach, the difference between the revenue and the earnings approach was $80,000. Why is that, and which one would you use?
Well, I'm going to use both of them, but I would definitely weight the seller discretionary earnings or earnings multiple more, usually 2/3 to 1/3, relative to one another. Primarily because cash flow is king in a business. So that seller discretionary earnings number is far more important to a buyer than the total revenue number.
Now, there are certain instances where we have a strategic buyer that will bring their own cost of capital and their own capital structure to the deal. And they may care more about the revenue than they do about the earnings because they'll have their own economies of scale. And so they'll be applying their own expenses to it. So they may not care, or they may care less about the seller's discretionary earnings. But usually, you're right. It's the earnings because that's how I pay the bank back and pay myself.
Yep.
Great.
Okay, yeah, there's definitely opportunities, and we have the baby boom wave happening now. So there's lots of people, even amidst the COVID-19 crisis, we still have people who would like to retire. So there's still activity happening out there. Obviously, the economics have changed for some industries, but we're still in business, and we'd like to help you out if need be. So, Eric, you mind wrapping us up here?
Yeah, the first step in selling a business is always determining the value of that business, and it's a very complicated process. It's not that simple, and it's the critical step to get started in the sale of your business. Because so many business owners, when we do a valuation for them, find out that, there's just not quite enough money there for me to retire or move on to the next phase of my life. I need to, accumulate some more wealth prior to selling. So, it's something that, we take a lot of pride in, in doing our valuations, and obviously with Mike on board as a certified business appraiser, we can go all the way up, to those certified appraisals that are, bulletproof in the court of law, support, the SBA and banks and their lending, all the way down to the business broker's price opinion, which is, obviously just a very quick analysis, using all the tools we just mentioned to make sure that we get an accurate portrayal of what we think that business is worth and what it will sell for in the open market. But, it's something we really enjoy doing, and we're happy to do that broker's price opinion on a complimentary basis. If you're looking to sell, obviously, if you're looking to do more than that, as Mike said, some of the certified business appraisals, do have a cost to them, but we're happy to help you with whatever your needs are, in the valuation arena.
All right. Well, thank you. Thank you all. Thanks for joining us.